I'm John Leske, recently retired personal financial planner and founder of finhealth, a tool to guide you to your financial independence. This is the fourth in a series of 8 videos that explains finhealth and how it can help you reach your version of financial independence. That is, having sufficient investment wealth to support your desired lifestyle indefinitely without needing to work. It is recommended that you watch the previous videos if you haven't already done so. In the third video in the series, we considered the logic behind the investment wealth ratio. It looked at the proportion of total wealth held as investment wealth as opposed to lifestyle assets. An investment wealth ratio above 55% at retirement indicated that wealth was not unduly weighted to lifestyle assets, and that future hard choices between maintaining lifestyle and/or selling desired lifestyle assets would most likely be avoided. But an above benchmark investment wealth ratio is not itself enough for financial independence. A critical requirement is to directly examine how many years of desired retirement or financial independence spending can be supported by investment wealth. We call this ratio the retirement expenditure multiple. It could just as easily be called the financial independence expenditure multiple. The finhealth Key Measures report provides both a current and projected retirement expenditure multiple. The current retirement expenditure multiple is calculated as current net investment wealth divided by desired annual retirement spending. The projected retirement expenditure multiple is projected net investment wealth at retirement divided by projected desired annual retirement spending. Projected net investment wealth at retirement is your projected investment wealth at the time of financial independence and/or retirement. It is the value of your current net investment wealth plus your estimated future savings at retirement, assumed to grow at an investment rate regarded as consistent with your attitude to investment risk. Your estimated future savings or future capital is potential but yet to be realised investment wealth. Future capital could come from a number of sources, including 1. The excess of your after-tax earned income over your spending, that is, your savings. 2. Receipt of inheritances. Although the desire to provide gifts to others, say your children, or leave inheritances other than your lifestyle assets, will reduce future capital. And 3. Sales of lifestyle assets, for example, taking equity out of your home by trading down your residence. On the other hand, future purchases of lifestyle assets, e.g. home extensions or trading up your residence, will reduce future capital. Explicitly including future capital as part of your total investment wealth provides insights that are conventionally otherwise missed from many major financial decisions. These include decisions as how much you hold as defensive assets, that is, lower risk investments, versus growth assets, higher risk investments. This is a very important asset allocation decision. It also helps you look at the decision of how much you can afford to borrow. For those early in their careers, your future capital usually is the major component of your projected net investment wealth and may dwarf current net investment wealth. Your current retirement expenditure multiple measures how many years of retirement spending current net investment wealth could confidently support. The projected retirement expenditure multiple measures how many years of projected retirement spending your projected net investment wealth would support. As a rule of thumb, for financial independence, we look for a multiple above 25 years for both retirement expenditure multiple measures. For those who plan to retire at age 65 or a little earlier, Significantly earlier intended retirement may require some upward adjustment in this benchmark. A multiple of 30 may be more appropriate for those intending to retire earlier than age 55. The benchmark retirement expenditure measure is assumed to gradually reduce for retirement after age 65. Obvious questions include, why is 25 years an appropriate benchmark? And how do I calculate my desired level of spending? With regard to the 25-year benchmark, numerous studies have shown that, historically, a balance, that is 50% conservative, 50% aggressive, well-diversified investment portfolio equal to 25 times the desired annual inflation-adjusted level of spending was sufficient to fund a 30-year retirement 90% of the time. That is, there was about a 10% chance of failure. So the benchmark suggests that if you wanted to fund a $100,000 a year lifestyle, increasing with inflation for 30 years, a $2.5 million well-structured portfolio would provide you with a high chance of success based on historical observation. While the rule of 25, implying an initial withdrawal rate of 4% of the investment portfolio balance, is not universally accepted, I haven't seen any methodology or approach that suggests it's not a very good starting point when answering the question, how much wealth do I need to fund a desired lifestyle without the need to work? If you should be aiming to accumulate at least 25 your desired level of retirement spending, the resulting calculation will be useless unless you are able to make a reasonable estimate of that spending. If you are many years away from retirement, this exercise may appear a bit frivolous, and things will continue to change. But projecting forward and regularly reviewing your estimates will increase the chances that you are both financially and emotionally ready for financial independence or retirement. A particularly important area to focus on in making retirement spending estimates that is often overlooked or given insufficient attention is what we call capital maintenance. This usually refers to the cost of updating the family home and replacing motor vehicles. These generally imply lumpy, irregular outflows that are often disregarded when estimating expected ongoing spending. No former client ever told me that they wanted to run their existing motor vehicles into the ground or let their house fall down around their ears in retirement. The general expectation is that these capital items will be refurbished or replaced so that their pre-retirement standard is at least maintained. I'd like to suggest a couple of rules of thumb to take account of this expectation. For motor vehicles, include a replacement allowance of 10% of the new value of the desired vehicle in the estimate of annual retirement spending. For residences, include an allowance of about 2% of the estimated replacement value of the buildings and contents in annual spending. So exclude the land value. So, if the desire is to own motor vehicles with a current new value of $100,000 and the residence replacement value is $1 million, the rules of thumb suggest you include a capital maintenance allowance of at least $30,000 in estimated annual retirement spending. That is, $10,000 a year for the car replacement and $20,000 for house maintenance or upkeep. While I can't guarantee the accuracy of this methodology, it does explicitly recognise that there is a cost to maintain capital, and it is potentially significant. In some years, little of this allowance will be required and should reflect in lower than estimated drawdowns on investment capital. But in years when vehicles are replaced or major updating of the residence occurs, spending could be well above the allowance. So, using the examples discussed earlier, a retirement spending estimate of $100,000 a year increases to $130,000 a year when capital maintenance is considered. Using the retirement expenditure multiple benchmark of 25, the investment wealth to support this spending goes from $2.5 million to $3.25 million, a very significant change in wealth required. So, for self-funded retirees looking at potentially 25 to 30 years of relying on only their investment wealth to support them, a retirement expenditure multiple of at least 25 years provides a good rule of thumb to indicate financial independence. In saying that, however, it's also not a case of the higher the multiple, the better. Just as too low a multiple indicates changes may need to be made to achieve financial independence, too high a multiple also raises financial planning issues. A multiple above 40, for example, may indicate excessive concern regarding the danger of running out of money and a failure to get maximum enjoyment from hard-earned wealth, either in terms of enjoying a better lifestyle or using the opportunity to help others. While it is impossible to guarantee that someone will never run out of money, regardless of their current retirement expenditure multiple, when it comes to attaining financial independence, it is necessary to acknowledge that at some point, at least in a relative sense, enough investment wealth is enough. Even if you are able to accumulate at least 25 times a well-considered estimate of desired retirement spending, it is also important to consider how tax effectively investment wealth is held and how investment risk is taken. I'll look at these issues in the next 3 videos. Finally, let's have a look at how our case study family, the Barbers, discussed in previous videos, fare on their retirement expenditure multiples. Not surprisingly, their current net investment wealth would only support 5 years of current desired retirement spending of $160,000 a year. Net investment wealth is only $800,000 compared with the $4 million required to meet the benchmark. However, their projected retirement expenditure multiple at 20.1 years also suggests they are likely to fall short of meeting the financial independence benchmark at retirement. A desired level of retirement spending of a little over $193,000 a year suggests a projected net investment wealth requirement of $4.832 million compared with the estimated projected net investment wealth of $4.21 million. The projected retirement expenditure multiple provided on the Barber's personal financial dashboard suggests that they will never reach the benchmark, despite declines in that benchmark with age. While not a massive shortfall is indicated, the projections provide an early indication to the Barbers that some tweaking of their expectations may be required to be confident of being financially independent by Pete's age 65. Together with projections of an undesirable skew to lifestyle assets versus investment assets, as shown by the projected investment wealth ratio and discussed in the previous video, the Barbers could be looking to make some modest adjustments now to increase the chances of achieving their version of financial independence. In the next video, we'll look more closely at the need to also be tax aware to increase the chances of achieving financial independence. We do this by using the tax effectiveness ratio as a proxy. So hopefully I'll see you then. Please comment or ask any questions below and I'll respond to as many as I can. Thanks for watching.